Thanks for having a relatively short lunch. We've got a lot to cover. And as I said, I think this particular presentation is going to be the most actionable and relatively important session of today. This morning we talked all about the macro stuff, big stuff that's going to take 5-10 years to play out or more. But now, this is something that we can action today or over the next couple of months. And probably once a year, I will stumble across something which is like, interesting. And then I put a fair amount of conviction behind it. So last year, if you can all remember, my conviction play last year was Olympus DAO, Ohm. Now, obviously, we all know what happened with that. But if you got in relatively early like I did, I actually made a lot of money from Ohm. And I exited. So I got, when, who was in the RT community around last year before the DAO explosions? Cool, okay. So hopefully you all saw that we got into Olympus at around $300, $400. It ran up to sort of $1,300 and then started correcting. Well, once it broke that base support level, like I was mentioning today, that is like my number one rule. If I had the 10 commandments, the number one would be, when base support is broken, get the hell out. So it broke base support, and I exited Ohm at $950. It's now $14 today. So it has crashed precipitously. But it doesn't mean, just because something has crashed, doesn't mean it wasn't a valid investment move. And it was valid. So timing, obviously, is everything. And I've got my next conviction play, which is Ethereum. So when you look at it from a risk-adjusted perspective, I actually think Ethereum is probably the best out there for the least amount of risk with the maximum amount of reward. And one of the questions I ask myself every month, or probably every week, is crypto going to die? Always start from the biggest picture possible. Is crypto going to die? As in, is Bitcoin going to zero and it's just going to whimper into the history books? No. It's highly unlikely that it's going to die. Okay, will some die? Yeah, okay, so we've got two things there. We've got a bunch of cryptos that are likely to die or will die, and some which won't. Okay, which is the least likely to die? Well, Bitcoin is probably the first one up there. Bitcoin is probably the most solid. Okay, what's the second most solid crypto out there? Ethereum, cool. And then you can it's basically the top 20 of coin market cap, really, ignoring the stable coins. And pretty much most things on page one of market cap is going to be relatively solid. And then you have to start looking at, okay, where are the best rewards? So obviously it's the shit coins, the low market cap coins that are going to give you the 100,000, 10,000x returns, etc. But you're taking that risk on board. You're taking that reward with that huge truckload of potential tail risk that it could go to zero. So when you look at it from a risk-adjusted perspective, I can't find anything that comes near Ethereum. Putting it from a software perspective, there's a few software engineers here. To keep a platform, a website, code, or anything up 99.99% of the time is relatively easy. The more nines you add onto the end, the more zeros it's going to cost you. So to have something that has an uptime of 99.99% is going to cost you a lot more money than 99.99%. And I think Google has an uptime of 99.999, I think it's 69% of the time, something like that. And it costs them billions to do so. Now, I'm not a techie, but from my limited research, I think over the last 30 years, there's only been one thing that has had 100% uptime, and that's Ether. It's phenomenal. I don't think anything out there has a 100% uptime. Since it started churning out its first few blocks in 2015, it has never had any downtime. Yes, it's been a few attacks, there's been some DDoS attacks and whatnot, which has slowed it down, but it's never stopped. And even Bitcoin, you can think, well, what about Bitcoin? Nope. Early on in Bitcoin's career, they had to reverse a few blocks and whatnot. No, not reverse a few blocks, but technically, Ethereum is pretty much the only thing that has 100% uptime. It has never faltered. So why am I? Obviously, I've been a big fan of Ethereum, for basically since 2016, really. It's always been up there. I got in at $9 originally, which is pretty funny. But things have changed, and I think that it's just getting better. So when you're looking at a crypto, if it's going to moon, what are the two things that really propel it? So in fact, what's the most important thing that will make a crypto moon? What is the root cause? What is the most important root cause? We have, I need to give away some alcohol here. We have the world's cheapest Prosecco on offer here. Yeah. Network effect, okay. And yet, that's not quite. Sorry? Community? You get a community, that's more of a byproduct. So who said something? Marketing, no. Sorry? Trust, yeah, sort of, but that's a byproduct if you get the other thing correct. No, keep talking. No, use case, no. No. All of these are byproducts if you get one thing correct. Utility value, sort of, but in order... Sorry? Reliable, no, okay, I'm going to have to... No. Market, no. Oh, no, you lost out on cheap Prosecco. Sorry, there'll be other opportunities. Tokenomics, okay? Now hear me out before you go, oh, no, it's not. You get all of your answers were completely valid, but they're all byproducts of a crypto that has really good tokenomics. If you have really good tokenomics in a platform, you'll breed, and also you've got good coding, yes, you'll get trust, you'll get the reliability, you'll get the marketing, you'll get the hype that comes along with it. Because ultimately, it's the hype that really propels a coin, right? But you don't get the hype unless you have something that's really driving it. So there's two real things. You need positive tokenomics. So for the non-crypto people here, tokenomics is like the economics behind a project. So, for example, the amount of coins in circulation is an element of tokenomics. If you have 10 quadrillion tokens, you can have a very low price, and not many people probably like it. Whereas if you have something of more, smaller supply, it's going to have a higher price. I mean, this is just one teeny aspect of tokenomics. So you need positive tokenomics and various triggers, and it's that triggers hype and the messaging. So where's my pointer? So once you have that, the top bit here, it then leads to hype and messaging, and then the demand quickly follows. The demand is the byproduct of doing stuff correctly up here. So we're going to talk about three things, which I think, I've been aware of them for a while, but I think I've been sort of saving this because I think it has been a bit too early, but now I think now we're seeing the dip in crypto assets across the board. I think now is probably the time to wheel out this somewhat old thesis, because this has been around for a good couple of years. So first of all, there are huge tokenomic changes inbound for Ethereum. Who can tell me what EIP 1559 is? Other than Josh. Who said that? Who said the burning? There we go. Tim, got some cheap Prosecco. There we go, otherwise known as the London fork. So last year we had an update called EIP 1559, which basically meant that the base fee, so every transaction, whenever you're sending Ether somewhere or sending money from one place to another, you're paying gas fees, right? And a part of that is called the base fee. So 30% of that base fee is burned. No, sorry. 70% of that base fee is burned, 30% goes to stakers. And so that London change, or the 1559, meant that real burning is happening with all Ethereum transactions. Now that's really positive because it's circulating supply that's getting burned. Now, here's how some shitcoins will try and fool people. And they go, hey, here's a shitcoin, here's my project. Every day we're going to burn all sorts of coins or whatever. And it doesn't touch the size. It has zero effect on the price. Why? Because the founders, the scammy founders, would have had 10 billion coins or whatever locked up somewhere. They're not circulating. And then they're going, hey, well, I'm killing 1,000 here or 1 billion here. It doesn't affect the price because it was never circulating in the first place. So you can get some really, iffy token burns. But if you're burning tokens which are circulating, that affects the price. So we're having So Ethereum has always been a positive inflation project. So there's always been lots of tokens being created on a daily basis because it's a proof of work, it's being mined by miners. But now, as the system, so it's pretty low at the moment. So network activity is pretty low on Ethereum. But when we get out of this bear market and activity picks up, there's going to be huge amounts of burning. And I'll show you exact figures in a minute. So ETH circulating supply is about to decrease in a meaningful way. So we've got the burning. That's not the real thing. The real thing is, sorry, I've just talked about this. Yeah, fee burning. So roughly, they're going to be burning 11,000 ETH a day, roughly, which is quite a lot. Second thing is the amount of staked ETH. So right now, there's roughly 13 million ETH locked up on the Beacon chain, which is basically, you're staking Ether, right? And you're locked up, you can't move it until ETH 2.0 comes out. In fact, not even then. It's 3 or 6 months after 2.0 is launched, then you can start unlocking your staked Ether. But what's happening is that this is growing a lot faster than most people think. So Coinbase did a big study about 6 months ago when it was, about 8 million? No, probably, yeah, about January. Yeah, it was about 8 million locked up. And this person, his name is called David Dong, what a name. And he said, a good target of staked Ether would be, something like 13, I think it said 12.5 or 13 million by 2024. Well, we're already at 13 million. And as we get closer to the merge, as in where Ether 2.0 is going to be launched, which is going to be roughly on the 19th of September, so very soon, if it goes off without a hitch, this is going to start really picking up. So that staked ETH is obviously also reducing the circulating supply of ETH, 13% and rising. Also, once the merge happens, the yield is instantly going to double, roughly. So at the moment, it's about 4 to 5%. On the merge, it's going to start off at about 10.7%. But it will then quickly fall as more people start staking. And so that's the beginning of a little positive feedback loop. And a lot of people will go to ETH because you can't really stake Bitcoin and get yield from Bitcoin, but you will and can get a very nice yield from Ether. Now, just like staking, like normal, for those who are not familiar, when you stake a crypto, the yield you get is in the token, not dollars or pounds or rupees or yen. So if you're staking ETH, every day you're going to be getting paid out in ETH. So yes, you may be making, let's call it 8% yield per year in ETH, but when the price starts growing, let's say the price of ETH 10x's, all of a sudden, so too does your cash flow. So yes, right now, if you staked and or let's say on the merge and you start staking, you're making say 7 or 8%. Yes, if the price of ETH stays flat forever, yeah, you'll make 7 or 8%. But if the price 10x's, you'll be making 80% yield, etc. And also, you get the PAG, the potential appreciation gain of the token going up in value in itself. That's going to attract a lot of people. Now, issuance, this is the crazy thing. This is what I'm excited about. Issuance will drop by 89%. This is huge. So what's happening is that the moment we move from proof of work to proof of stake, because this is what this whole ETH 2.0 is, where they're just chinning off the miners and we're going to proof of stake, issuance will drop by 89%. So what this means, as it says here, right now, they're chucking out 13,000 ETH per day, and staking rewards are 1,600 ETH per day. After the merge, only 16, so basically the mining rewards just stop. So after merge, 1,600 ETH per day will remain, which means it's roughly a 90% drop in issuance, which means that massively affects the stock to flow. Now, again, for the newer people who are not arty people here, the easiest way to understand stock to flow is with gold and silver mining back in the day. So if let's say you had 100 tons of gold and only, 10 tons a year were being mined, and you had a certain price. If all of a sudden something happened and you're only mining half the amount, what should happen to the price? It should double, if everything else being equal. If the amount of supply halves, the price should double, if all things being equal. Well, it's similar things here. That's what stock to flow is, to a degree. And so what's happening here is that the supply isn't halving. The supply is dropping 90%. And so, yes, it will still become an inflationary issuing crypto, but it's going to drop precipitously, or roughly 90%. And so, yeah, and at least 1,600 ETH will be burned every single day from just bog standard base fees, which almost brings it to a zero inflationary coin. But the kicker here is that over time, it will become a deflationary project, as you can see here. So there are several stages. So basically, with so EIP 1559 was over here. All the stuff that's happened so far, I've done absolutely bugger all. But point 3 is the end of mining, i.e. the merge. This is where issuance will drop 90-odd%, which means that Ethereum will only grow roughly 0.49% per year, but it will drop very, very fast. The more people that stake, that will also drop it. The more people that use the network, because let's say it attracts more people and more smart contracts, and let's say DeFi 2.0 begins in the next bull market, this is going to drop because of the fee burning. And then eventually we'll be into a negative stock to flow situation. This is huge, absolutely huge. And so some people are calling it the triple halvening. So for those who are not familiar, one of the reasons Bitcoin has done so well over the years is that every 4 years it goes through a halvening. So back when it originally launched, every 10 minutes, 50 Bitcoin were released to miners. And then 4 years later, it had a halving. So then it was 25 Bitcoin were released every 10 minutes. Then another halving, 12.5. And so now only 6.25 Bitcoin every 10 minutes is being released to the world. So we've had basically three halvings since Bitcoin launched. And what has the price of Bitcoin done since? Well, it's gone basically from 10 cents when it had first price discovery in 2010 to 20 odd K where we are now. Huge growth. So, and that's three halvings. This issuance drop of 90% means Ether is effectively having three halvings in one day. That's on the 19th of September is the most accurate date. And that's what, like 5 weeks away? No, 6 weeks away? Half a month? No, 2 months. 2 months. Shit. So I think now is a really good time to start being aware of this. And so yeah, it's the triple halving. And there's so I think there's a website called ultrasound.money, and there's all sorts of tools on here, and it gives you a little calculator here. So when I last took the screenshot, I put 22nd of September, rough base fee burning and the amount of, and I was trying to propagate how much staked Ether would happen. And so this is the merge, so proof of work removal. And then you can see that like this staked, I reckon this will just continue going up, especially now that the yield will double straight away. It's going to attract way more people to stake, and it should grow pretty fast. But what this basically means is that the total issuance of ETH is going to pretty much stay flat for a fair while. So, and that's huge. So if something has a flat circulating supply, but demand goes up, price also goes up. I don't think I'm giving this enough weight or gravity to it, but this is a big deal. So that's the sum of the positive tokenomics and triggers. Now let's look at the hype and messaging. So the narrative is evolving as Wall Street becomes more informed. So Wall Street is pretty much divided at the moment. We have not even half, I can't even say half, it's probably 10% of Wall Street that have been very crypto-minded, and they've already put money into crypto. You have the thing that, Mike Novogratz and, Michael Saylor. In fact, Michael Saylor, you can't even call him Wall Street. He's just Bitcoin Jesus. But the narrative is evolving, and you have all of these hedge funds and sovereign wealth funds and fund managers that missed the boat in 2017, 18 and onwards. And they've seen all of the people that bought Bitcoin at $2,000, $1,000, and they've seen it rally, and they're like, oh shit, I couldn't get into Bitcoin because my fund wouldn't let me, compliance wouldn't let me, yada, yada, yada. Well, what happened last year and this year is that massive corporations started buying crypto. Tesla bought crypto. MicroStrategies is constantly buying crypto. And then we had that massive event that Bitcoin Jesus held, and 700 corporates, so pretty much 700 of the biggest companies in the world, all met, and Michael Saylor and his team basically told them, here are all the bullshit hoops that we had to jump through to buy Bitcoin, and here, we're giving it away for free. Take it. So you have all these CFOs, CTOs, and CEOs going, this is the blueprint, how we can get access or put money into crypto from an institutional point of view. And nothing happens quickly. So if you take a massive oil tanker type company and they want to go, I want to buy Bitcoin, it's going to take them 12 months just to jump through the compliance hoops. And that's been happening a lot last year and this year. But here's the other thing. A load of these Wall Street type people are going, I missed the boat on Bitcoin, but I'm not going to miss the boat on Ether. Ether is going to be Bitcoin 2.0, basically. And they're going to self-justify all of the changes that are happening and a few more. So they'll say, Ether doesn't have these scalability issues anymore because there's so many layer 2s jumping up, which are going to handle all of the scalability stuff. Gas prices will stabilize eventually. I must make this clear. The merge will not affect gas prices. Okay? So all that's being a bit technical, all these changes are on the consensus level. Gas prices will happen when sharding comes in next year. So as in gas prices will drop, probably 80-90% next year when sharding comes along. But what this will do is it's going to help DeFi 2.0, so decentralized finance. We had the first round of hype and rubbish with DeFi in 2021. But obviously, most of them are died and dying. Celsius, gone to pot, 3AC, all that sort of stuff. The next round, I think they're going to be using, a lot of them will start flourishing on Ether. And yeah, so Wall Street who missed the boat, they're not going to miss their chance with Ether. And Bitcoin just doesn't have that same narrative anymore. Don't get me wrong, everything I said at the last cuddle 3 months ago is still valid. Bitcoin as economic energy, all that sort of stuff. But also, I was talking about the ETH Bitcoin ratio, the seesaw flopping years before Wall Street. Those who've been in RT for at least 5 years have heard me talk about the ETH Bitcoin ratio. And I drew this chart a long time ago. And for a good 4 or 5 years, I've said Ether one day will be 1/10 of the price of Bitcoin. As in, this ratio will be 0.1. And I started drawing these things. I mean, this was back in late 2019. I started drawing these lines. And we made a fair run for it in this last rally before sort of falling over a bit. But we're going to get there. And I actually think it's going to go more than that. We will see the flippening, I reckon, next year, where the market cap of Ether will become bigger than the market cap of Bitcoin. It's also incredibly, this is the only cringy bit for myself, store of wealth. You can really only call something a store of wealth when it's had a fair enough track record. Ether's only been around since 2015. So yeah, I should probably remove that. You can't call it a store of wealth. Yeah, the network will be booming on all metrics. Rise of, DeFi 2.0. And it is programmable money to a degree. You have smart contracts. You can build stuff on top of it. You can't do that with Bitcoin. If you wanted to revolutionize the property world and buy and sell houses on crypto, you can easily do that on Ethereum. You can't really do that on Bitcoin. Smart contracts, is going to really shape the world over the next 5 to 10 years. The other thing I look at is the dev activity. So I forgot to mention this on my shitcoin thing. You can actually check up on GitHub and see how active the coders are for whatever project. Well, surely a very active project with coders and being active, that's a very good indicator of is this a good crypto? Well, Ethereum is nearly always at the top. It's got more coders than anything else on the planet, than any other crypto on the planet. It's got more monthly full-time coders. So yeah, it's a country mile away. And that's comparing some of the other big ones. Also, yeah, full-time monthly developers. Ether is way up here. But check out Polkadot. Ooh, sexy. That's like the sexy sister of Ether. So I'm very big on DOT, by the way, as well. So I will be presenting about DOT probably next quarter, next cuddle. But I want to be going pretty heavy into DOT. But it's still winning. No one can beat Ether just yet in activity. Also, whether, I don't care about your opinions, whether you agree or disagree with the whole ESG and the WEF type stuff, but I think it's clear to see that everyone is going to be chronically obsessed with ESG moving forwards from now on. Everything must be environmentally, socially, and environmental, social, and governance. And everyone doesn't, or no one understands Bitcoin really in terms of how it uses its energy. And remember the last cuddle, I talked about Bitcoin as economic energy and how the power that it uses for mining is not wasted. It's actually, that's what gives it its value. But people on Wall Street, analysts, they won't understand it. However, what they will understand is, oh, on the 19th of September, all of a sudden, Ether will use 99.9% less power than it previously did. And all of a sudden, Ether becomes tick, tick, tick on the environmental boxes. So yeah, this is the amount of power, terawatt hours per year, that it takes to run YouTube. 244 terawatt hours. That's just data centers, by the way. Gold mining is pretty intensive. You then have Bitcoin. So it's still, everyone goes on about Bitcoin mining, but they don't talk about YouTube, do they? Or PayPal or anything. ETH is about half of Bitcoin's energy consumption. Then Netflix, gaming, and that's growing fast, by the way. PayPal's down here. But after the merge, it'll be 0.01. It'll literally disappear. It will tick that very crucial box. And I don't think, moving forwards, institutions, hedge funds or sovereign wealth funds or pension funds will even be allowed to put their money in anything which is not ticking all those ESG boxes, whether you like it or not. Oh yeah, so 99.95% reduction in energy. Great narrative, right? Remember, this is all part of the hype and the narrative that will be spinning. And when you, someone quite handily converted, the equivalent of energy power into height. We all understand height. It's hard to understand terawatt hours per year. So if you look at Bitcoin in terms of energy usage, that's like the tallest building on the planet, the Burj Khalifa. Then ETH proof of work, as in how it is right now, is the Leaning Tower of Pisa. But in September, mid to late September, ETH becomes as tall as a screw. So if you can compare energy consumption to height, that's what it's going to be like. So that's a hype in the messaging. And then the demand. I think because they've fixed, or they're fixing all of this, the demand will naturally come. First of all, there's going to be idiots like me from Norwich. I'm small fry nobody. If I'm seeing this, I'm pretty sure the biggest funds in the world and their analysts have seen this or are seeing it. And there are a few funds that are actively sat there waiting, if that makes sense. So they want to get into Ether, but they're just waiting for the Ethereum ETF to launch, the US-based one. I know there's a Canadian one, which has already plowed billions of dollars into ETH, but everyone's still waiting for the US one. Now that will happen. The moment the Bitcoin spot ETF is launched, it's then a copy and paste exercise for Ethereum spot ETF, and that's going to just plow in billions into this. So institutional interest is growing. And guess what? If the institutions plow into something, retail will follow in. Retail typically follows the big boys. So yeah, everyone's, and it's not just one spot ETF that's sat there waiting to be approved by the SEC. There are dozens, literally dozens of spot ETFs. Grayscale for one, they've got about 4 on the pipeline, I think. Yeah, so as I said, corporates spend a long time in DD, due diligence. And so once they're allowed to, and they've completed all that for Bitcoin, it's literally just swap BTC with ETH and they'll be, copy and rinse and repeat. And new on and off ramps are coming online as we speak for institutions. As I said, getting fiat currency, your dollars, your rupees or sterling into crypto is the hard bit. It's getting easier for institutions. And eventually it'll get easier for retail. At the moment, retail's getting hammered. Yeah, so here's the thing. Most big funds have this $10 trillion thing, this level, and they're typically in their own internal bylaws not allowed to invest in anything too small. So $10 trillion across the board is pretty much that minimum threshold. So when crypto as a whole gets to $10 trillion, then they're going to start actively getting things ready. But when Bitcoin or Ether hit $10 trillion market cap, then it just opens up the spigots, and that dam just basically vanishes, and it will literally flood the market with cash. And I will take the bet that Ether gets to $10 trillion market cap before Bitcoin. That's my educated play. And so when that happens, just watch trillions of dollars flow into Ether, just Ether. It's going to be nuts. And then once it then is fully opened up, then it's down. Then IFAs can start allocating to whatever, ETH, ETF, etc. And I made inroads with one. What was this? This is when I was trying to set up a fund back in 2015, 2016. I made friends with this network, which had, I can't remember the rough numbers, but it was something like they had 10,000 IFAs across the UK, and those 10,000 IFAs were raising £600 million per week. And I couldn't understand, I didn't believe it at first until they showed me, and I was like, how do you raise 600? And it's because all these IFAs are going around, getting people's pensions into Vanguard, left here, BlackRock there. And so they raise so much money. And so once, the IFAs are allowed to put, and they'll probably be conservative. They'll say, oh yeah, I don't believe in crypto, or it's a bit risky, but it doesn't hurt to put 1% of your pension in this tracker, this crypto tracker, or whatever it may be, or 10%. And because billionaires are doing this, they've got top cover. Yeah. So yeah, as I said, I think once the retail market will understand that you can stake Ether pretty well and get, it's nothing like any DAO ROI, but get a good 8 to 9% to begin with. But obviously it's going to decline. The more people that stake, the lower the yield will become. But I reckon we'll have a good year where we can make between, 6 to 8% yield in the first year. Then the next year will probably be 4 to 6%. As it increases. So, yeah. Now, here's the thing. I said this in the trading pub the other day. I want to put as much tailwind behind my portfolio as possible. And so one of the key metrics I need in my portfolio from now on is revenue. I think I will only put money in crypto projects that have actual real-world revenue. Are they making money in the real world? Not just hype or bullshit or, they're spitting out tokens. Are they making actual money in the real world? Just like a business. You speak to any stock investor, what's one of the first things that they look at? Revenues. And then, earnings to share, EPS and all that sort of stuff. Price to earnings. Well, you can do exactly the same thing with crypto. And revenue is one of my main drivers now. So when you compare Ether to the top 10 layer ones, in terms of revenue, oh, by the way, this spike is Ether. So this top line. So Ether makes more revenue than any other crypto on the planet, by country mile. And this is against Binance, BSC, Bitcoin, Solana, Helium. Yeah, Helium, Polygon, Avalanche, Cardano, Arbitrum, Optimism. When you compare it to the top 10 DeFi lenders, still it comes out on top. Against the top 10 DEXs, you would have thought, decentralized exchanges do well. They do, not compared to ETH. And then here's the top 10 list. So if you want, I think, a no-brainer, here are 10 coins that you should probably have in your portfolio, simply because it makes quite a lot of revenue. I mean, a lot of people. I'm not sure about OpenSea, actually. I'm not a fan of NFTs. But I think OpenSea will probably drop once the NFT bubble really fully deflates. But yeah, it's wise to have revenue backing you up. So that's demand. So what does this all mean? It means frickin' buy Ether now, basically, or well, roughly now. And the cool thing is, no one's really understanding this. It's just hardcore crypto geeks like myself that are aware of the triple halvening, or or what's happening with the merge and stuff like that. So when you're looking at Google search terms, no one's really Googling Ether yet. The lion's share of crypto search terms is Bitcoin related. So this red stuff is Bitcoin search terms, blue stuff is Ether. No one's really understanding Ether just yet. Then we have to look at crypto market cap. Okay, so everyone calls this the dominance chart. It's rubbish. It's market share. Market cap, total market cap. So this orange stuff is Bitcoin, right? So we've been hovering around 80% market share of the whole crypto market. Then we had the ICO phase, so initial coin offering phase, in the 2017 area. And obviously, it dropped off a cliff because loads of alts just popped out of nowhere. And then we had the crash. And so typically what happens during crashes is that alts die and dominance, as they call it, goes back to Bitcoin because people want a safer haven. And then we have another rally of some sort of, this was, I guess, the DAO phase, the DeFi, phase back in mid to late 2021. So Bitcoin loses more market share. And now we're in a crash. It hasn't actually recovered too much. So Bitcoin is literally sat at around 45%, 40 to 50% market share. Now, I've always said Bitcoin will eventually just slowly drop to about 10 to 20% market share and will act like digital gold. And I really do think that because there are thousands of projects coming online. So just by default, it will have to lose market share, just the sheer amount of new projects coming online. But this is what I think will happen. Clicking the wrong button. I think we'll have the flippening in 2023 where Ether will not only have a bigger market cap than Bitcoin, it will just own a bigger market share of the whole crypto space. And don't forget, Ether, even in summer 2017, got to about 35% market share. And that was when it was really clunky, not scalable, horrendous fees, quite wildly inflationary. So I actually think we could very pessimistically get ETH to owning basically 40% of the whole market share. So then I got my little geek hat on. I thought, okay, let's crunch some numbers. Now we've got some rough pessimistic gauges. We can do some maths. So let's use 40%. I actually think it'll go higher. I think it'll probably hit 50%, but let's say 40. Shit, the maths comes in a bit. Hold on. So before we get there, this is total market share. I need to look at that. Yeah, so this is actually total crypto market cap. So right now, we are sat at just under $1 trillion market cap, which is just above the old highs in 2018. So I actually believe the next cycle, the next big push, will push cryptos to $5 trillion. This in trading is what's called a megaphone pattern. So this green line is what I think the crypto market cap will do over the next 4-year cycle. Well, I don't like using the word cycle. There's not really cycles these days. Basically, I think institutions are going to plow in, and it's all going to be institutionally driven. Like retail could just stop investing in crypto today, and I don't think it'll even dent the market because this is now Wall Street's territory. So I reckon we're going to have a nice little rally up to about $5 trillion in total market cap before we see the next correction. And remember, charts precede news. Charts nearly always tell you what the news will be, and I reckon it's going to be somewhere along this line, whether we quickly rally up to 3-4 trillion or maybe a bit later and 6 trillion. When it hits this top line, that's when I see the next pullback, and that's when I'll probably liquidate some stuff. So then we can do some maths. So if we use roughly $5 trillion for total crypto market share, we can then get out my old formula of MPC, more patient Kryptonians, which is market over price times circulation. So $5 trillion times 40%, that means the market cap of Ether could be $2 trillion. Then you need to divide it by the circulating supply, and I've been very generous here. I've put the highest circulating supply it could be. It's most likely going to be 115 million, not 121.5. But even at the worst numbers possible for Ether, this gives us a price of 16.5K, roughly. And I've been super pessimistic, really pessimistic. If, I don't really want to say this on stage, let's just keep it there. I'll tell you when I'm drunk what I really think. So worst case, in the most pessimistic model that I could calculate, I see Ether getting to 16K, 16.5K. over the next few years. Let's say even more pessimistically, over the next 5 years, Ether will go from $1,200 where it is now to 16K. I'm going to put that's my line in the sand. You can hold me to this. This will eventually end up on YouTube. Hi, YouTube. What's the date? 16th of July, 2022. Okay, let's mark that. So when I go back to the whole, best reward for the least amount of risk, Ether. This is like a 16x from where we are now. And so I'm going to be putting a lot of the portfolio, probably, so now, for me, the conversation in my head is, how much of the pot do I put in? Do I go 100%, 50%, 20%? And to be honest, I haven't worked this out just yet, because there's so many other coins like Polkadot, which are equally as amazing. But I wouldn't be surprised to begin with of having probably 75% of the pot in Ether and the rest in Polkadot and other bits and bobs. But I'll keep you abreast on the trading pubs every Thursday, don't worry. So here's my caveat, 16K plus or minus 10K. So I'm going to give you a rough range. So this is the total market cap. So this is the Ether price on a logarithmic chart, by the way, just because I couldn't squeeze it all on. So I reckon, so we're in this sort of channel, or technically it looks like a rising compression, doesn't it? But I actually think it's just going to be a rising market. So when we get up to this area, I'm thinking we're going to see ETH prices around sort of 8K to 30-ish K, roughly. That's my rough Mars bar pen on the chart. Pretty big fat Mars bar. But yeah, let's say 20K, I reckon. And then I'll probably start liquidating stuff or being very trigger happy, because we all know what support and resistance levels do. So this is my reasoned calculation on what it will be. But long story short, even if it just gets to 10K or 8K from now, it's still a 4x from where we are here. So moving on, you now hear my thesis on Ether. What about my whole portfolio? So like you all know, I've got basically 3 pots in my portfolio: sexy pot, saucy pot, boring pot. Now, I have no idea about football. I've never even been to a football match, but I know a lot of people like football, so I've tried to put this in footballing terms, for you, Steve, especially. So the way I understand it, you really want someone solid in goal, don't you? Someone who's, or do you need a solid striker? I don't know, that's what I'm showing my ignorance of football here. But if I was trying to think of this from a top-down first principles point of view, I would want a really shit-hot goalkeeper. Because it's like trading. Your portfolio will grow if you just lose less trades. So if you let less goals in, surely you'll be better. Anyway, so for me, the goalkeeper is ETH. That's my solid, backstop. I want a solid goalkeeper, and that's going to be, and it's in the boring pot. I mean, 8% yield, going down to maybe 4% yield over time. It's not going to turn the world on its head. Like when there will be low market cap coins that will do 100x over the next 5 years, not 15x like Ether. There will be 100x coins. Some of the gaming tokens out there could do absolutely crazy things. So who are my defense? Remember, I'm approaching this from a defensive point of view. So on Polkadot, it's going to be my main sweeper defender there. Then Binance, because it's the biggest retail, or one of the biggest retail exchanges out there, and they just make shitloads of money. So here's a caveat. On the charts of the revenue, it plotted Ether against all these other crypto projects, but it plotted it against BSC, which is their smart chain. It didn't plot it against Binance the company. If you were to plot Binance the company on that chart, it would have torn Ether to smithereens. Binance as a global company, I think they're making close to $1 billion a year profits, aren't they? Something like that. Getting close. So they make a lot of money. So of course I want Binance. And CZ is just solid. Cardano, I know a lot of people don't like Cardano, but again, when you look at the developer activity, there's a lot of development going on ADA or Cardano. Solana, yeah, saucy-ish. It has its problems. It's had a fair amount of downtime recently, but still, VCs are very much pot committed with Sol. Sol is basically a VC play, and I think they're too pot committed with that. I don't think they'll let it fail. Kusama is like the wild, racy sister of Polkadot. That's basically the testnet, effectively. It's like a live testnet, so you get better yields there. Then you've got Monero, so that's my... I always want a privacy coin in my portfolio because, remember, drugs, porn, and criminality generally drove the internet, and it's going to drive crypto and VR and everything else. So when we move into a world of CBDCs, so central bank digital currencies, and remember, CBDCs are not there to take out Bitcoin, they're there to take out the existing fiat system. So DigiDollar will be there to boot out the US dollar. Digi-Sterling or Digi-Pound or Britcoin or whatever you're going to call it is there not to kill Bitcoin, it's to kill the pound as we know it. So in a world of CBDCs where they have full optics on everything, what are criminals going to do? How are they going to launder their money? How are they going to hide their money? They will be forced into privacy coins. Now, not in 4 years' time when everyone's in a CBDC. They'll be shifting to privacy coins now, whilst there's very little optics on this whole thing. And I've said in many times, you could be a very bog standard crypto person and be the world's best money launderer, because there are certain cryptos out there where you can just basically just stop your paper trail, like your audit trail, and no one can find, especially with wallet burning privacy coins. So yeah, I do want some privacy coins, just because when that net finally does close in and CBDCs are forced down our throats, you're going to see all the drug money flowing into privacy coins. And I think Monero, because it's the biggest one with the most liquidity, I mean, if you're going to quickly, oh shit, I'm a drug lord, I need to hide $1 billion, you can't put $1 billion into Pirate Chain, can you? But you can do it into Monero because it's just got a deeper, bigger market. It's just more liquidity. And therefore, here's the other thing, here's the other spin-off. You can't do that on a centralized exchange. So you can't just, if I'm a big, I've got $1 billion in illegal drug money and I want to hide it quickly, I can't just put that over to Coinbase and then buy Monero, or can't do that on Binance because then you've got the paper trail. So it will have to be done by a decentralized exchange. So my radar is still looking for good decentralized exchanges. Really, I'm trying to think like a criminal here, basically. Where are the criminals going to go to launder all their money into privacy coins? So we need a decentralized platform, exchange, with deep, deep liquidity wells, and then we need to swim there as well, because the rising tide of these illegal whales are going to push our portfolios up. Sounds bad, doesn't it? But this is, remember what I said this morning, nothing is neither good nor bad, but thinking makes it so. Same thing. FTT, another exchange. Sam Bankman-Fried, he's just owning the world at the moment. Ethereum name service, that, again, making lovely revenues. As Ethereum grows, so too will ENS. Then you got Synthetics, which is like a data amalgamator to a degree. Uniswap, that's the decentralized exchange. So Uniswap is the biggest decentralized exchange right now. So I want it on my portfolio. And it's probably one of the longest serving or the oldest ones out there. We then have a decentralized trading platform, probably quite handy, DYDX. Then we have the real punts, Gala and Sand. Now, here is my thing. I know there's a lot of hype about gaming and stuff like that. I have not been impressed with blockchain games. They have been as, the graphics look like a 1990s Tamagotchi. And you're playing these shitty card collecting type games. Like Axie Infinity, I think is dog shit. The game itself, and the tokenomics, which is why I've been shorting SLP for forever. But it is just a matter of time until they create the next Fortnite or Call of Duty or Battlefield, but crypto version. Imagine, who makes Fortnite? I forgot who makes Fortnite? There's alcohol on the line here. Who makes Fortnite? Epic Games. Who said Epic Games? Hey. Would you like cheap Prosecco or red wine or chocolate? Red wine. Okay, catch? No. Sorry. Here we go. If I was the founder of Epic Games, I would be having massive conversations internally right now how we can cryptify, tokenize Epic Games as a whole. So I think it's just a matter of time until good games are tokenized to a degree. But here's the thing, games are transitory. Games come and go, right? They have their time in the sun, which may last a year or two, and then people move on to the next thing. So, for example, Fortnite is really a copycat of PlayerUnknown Battlegrounds. PUBG, basically, was huge for about 18 months, and then Fortnite came along and went, oh, we're going to copy that, but we'll make it cartoony. And then it went huge. And so games are probably only good for a couple of years. So I don't want to invest in crypto games. I want to invest in crypto game making companies like Epic Games, Activision, stuff like that. So you have these basically factories of computer games where, that will just be spitting them out every couple of years. Does that make sense? I want the people that build the games and they're not reliant on one particular game. So Sandbox, Gala Games, they're the, I'll call them computer game factory, so to speak. And by the way, I will make other, call it super sexy plays, where if there is the new game of the limelight, I may, invest in that. So as it stands right now in July 2022, this will be my fighting lineup, if that makes sense, with heavy, heavy weight in ETH and DOT in particular. And when I say heavy, to begin with, probably 75% ETH, 15% DOT, and then really the rest really spread out, probably 1% Gala, 1% Sand, 2%, and vice versa. But there'll be heavy weight in and conviction in DOT and Ether.